Hey everyone, in today's video, I'm going to be talking about 4 stocks that I'm buying throughout the month of November 2023. So we're just going to jump right into this. The first stock here is Pizza Pizza Royalty Corp. Pizza Pizza Royalty Corp here on the last year has been about flat, so that's not too bad given the market that we've had, up about 1%. You've also been getting about a 6.5% dividend yield on this one. For those of you who aren't too familiar with the royalty model, it works a bit like this. Every company who has a royalty fund essentially takes a percentage of total system-wide revenue, and that revenue that is agreed upon as the royalty. In Pizza Pizza's case, that's between, I think, 5 and 7%, depending on if it's the Pizza Pizza brand, the Pizza 73 brand, and what agreement that specific franchisee signed, goes into the Pizza Pizza Royalty Corporation, which is the ticker PZA that we're talking about today. And then that income that the corporation gets from those top line sales of all of their franchisee partners goes straight out to shareholders as distributions or dividends. So it's a really high cash flow, cash pass on from the royalty right into investors' pockets. Doesn't really have a lot of working capital, capital allocation, other things that can get in the way of you getting your monthly dividend check at the end of the month. And that's one of the reasons I really like these kinds of investments to accelerate the cash flow of my portfolio. Looking at Pizza Pizza in terms of their business, we're going to go through this one pretty quick because I've talked about it on a couple other occasions. But they've had a really decent track record of growing their absolute network. So we can see here Pizza 73, which is their brand from out west, primarily in Alberta, almost doubled since they got it in 2007. 57 locations, up to about 100 locations last year. This one in the middle, the non-traditional locations, they have about 200 of those. You can see that it actually went down from 2019 to today, and that's because these untraditional locations or non-traditional locations are more like concert halls, event spaces, venues for different things, stadiums, and they probably lost some of those contracts or deals during the pandemic when those places were shutting down. It wasn't as much of a focus. You can see it coming back a bit now from 2021 into 2022, but it's really interesting to see that you also get a slice of that business as well, no pun intended. And their growth just on their traditional business has been really strong if you look just year over year throughout the last 15, 20 years on that side as well. Going into a couple of the reasons why I think this is a good time to be buying the stock and why I've been adding it a bit to my portfolio over the last few weeks is because pizza as a category is a pretty recession-proof segment of fast food and of takeout food in general. It's pretty cheap. You can feed a lot of people. You can warm up leftovers. And as people maybe go out to dinner less if their wallets are being pinched, it's a great way to not have to cook a meal or to get together with friends to watch a sports game or watch a TV series and be able to feed everyone something that everyone doesn't mind eating. So I think it's just a recession-proof category, and I'm not really sure where their economy is going to go, if we're going to kind of keep rolling or if these interest rates are eventually going to have pretty significant impacts. So I have a lot of stocks in my portfolio that will benefit in a great way if the economy keeps trucking along or accelerates. So it's nice to kind of just diversify and also be hedged a bit the other way, knowing that the money that I'm putting in Pizza Pizza, in my opinion, will be relatively safe as long as nothing completely unreasonable happens in the economy. So you can see here, even in the pizza segment, they do a lot of value plays and they play on value in their marketing a lot. They do fixed rate pizzas, which is if you download their app, you can lock in the price of a pizza today for the next 12 months. Even Pizza 73 looks like they're doing a lot of those types of activations as well. And another interesting growth area of the company here that I wanted to share was just international expansion. So while the 6.5% dividend yield is only on the Canadian stores right now because they don't really operate in other areas, that's about to change. They just opened up a couple PZA pizzerias in Mexico, which is an interesting market. I think they have ambitions to get that up to 10 locations pretty soon, which would be about 1% of the overall business. So not necessarily material, but great to know that they're looking at growing the company in new markets, since Canada is pretty saturated, both with Pizza Pizza and just pizza chains in general. Could also be some cool crossovers in terms of the products that they're offering in Mexico. I think they have some exclusive local products, so maybe doing those tests in certain Canadian provinces or whatnot to see how they do with those products could be an interesting same-store sales growth test for the company here. And then just lastly, this is mostly an Ontario play. You can see about 2/3 of the locations in Ontario. As I was saying, out west, they primarily have their Pizza 73 brand. And then other than Quebec, they're very scarcely represented in the rest of Canada. So you're really investing primarily in an Ontario pizza chain if you're buying this stock. The second stock that I'm buying throughout the month of November is Google. So you can see here, Google has gone on a bit of a run here in the last year. Year to date here, they're up actually 46%. You can see that they really got hammered at the beginning of the year based off of just some rhetoric around them being behind Microsoft on AI, Microsoft coming at them for search with Bing and all these other deals and whatnot going into question. They also have some regulatory risk with the US government. They went all the way down to $88. They've flown back now to $130 a share here, still trading about 5-6% off their year high at 140. But they just reported their earnings, and I went through them, and I was pretty impressed with the earnings report here. So just taking a quick look, you can see Google search, huge business, largest advertising business in the world, grew 10% pretty much from $39.5 billion to $44 billion in the quarter. YouTube, which was kind of slowing down in the last year, huge growth from $7 to $8 billion. And then looking at some of their other divisions here, you have Google Cloud from $6.9 billion to $8.4 billion. It's like 20-25% growth on the cloud business. Other bets I don't really pay attention to because the more money they make in revenue, the more money they end up losing on the bottom line. And one thing that I was really impressed with Google about is just the amount of employees actually went down 187,000 to 182,000. So I know they probably overhired before during the pandemic, but they grew their revenue pretty much 10% on a lower employee base of 4,500 less. So that was pretty impressive as well. And I like that they're caring about kind of the cost savings initiatives as well as they try to scale the business. That was interesting to see. Google has one of the best balance sheets in the world. You can see here total assets about $400 billion, but I like to focus more on current assets from 164 a year ago to $176 billion. This is primarily money that's just sitting in treasury bills or about to be paid to them, $176 billion. So that's on a $1.6 trillion market cap. They pretty much have 10% of their company's value in current assets just sitting there. Compare that to current liabilities here of $86 billion and long-term debt of $13 billion is pretty much nothing. They can pay this off today and still have $70-80 billion, which is a good chunk of their value sitting in cash. So I think they're really well positioned as we look at just technology in general and the space they're in, with AI becoming a really big opportunity across their business and cloud becoming an increasingly large focus for the company. They have tons of money there for them to invest in those businesses, whether it's through little acquisitions. I don't know if they can make big acquisitions, but they can probably do some tuck-in acquisitions on cloud, or just investing organically in R&D to drive growth through AI, through their cloud offerings with customer acquisition and whatnot. Lots of dry powder here, so they're definitely not going to be coming into that battle from a position of weakness versus other big tech companies. This is a phenomenal balance sheet, which is one of the reasons I really do like the company, especially in a high interest rate environment where some investors are concerned on interest hampering debt servicing costs. If anything, it's actually beneficial on an operating stance from Google because they have more money in T-bills probably that are yielding that interest rate versus what they're paying out on the debt. So that's just something to think about. And then just from an earnings standpoint, just wanted to take a second look at cloud here. You can see cloud went from about a $500 million loss in the last year quarter to a $250 million gain. So that's while $250 million over 21 billion is not a big deal, the huge swing of from losing money to not only breaking even but now starting to make real money is a double whammy tailwind for the company. So last quarter it was about $700 million as well. This quarter looks like it's another $700 million. So quarter over quarter, they're continuing to drive more growth from top line. And now that they're gross margin positive, this is going to soon become a bigger and bigger part of the overall mix, which I think is a really great thing for the company. It helps diversify the company. But in addition to that, cloud is something that will likely grow for years in, years out. So it really does provide them another growth lever and multiple expander on the valuation of the overall company. Other bets, one of the more frustrating things about owning this company seems to just burn $1 or $2 billion a quarter. Nothing's really come out of it in 10 years. So that's one of my pet peeves with owning Google. I wish they would just burn that division and return the excess capital back to shareholders. But it is what it is. In terms of overall share count, which is something that I wanted to take a look at here, you can see they've done a pretty good job at returning value and capital to shareholders through buyback. So you can see here went from $13.1 billion a quarter ago to 12.7, not but dollars, shares a quarter ago to 12.7 billion shares this quarter. So they bought back about 3% of the company from last year to this year. That's pretty solid in my opinion, especially for a company that has also built cash on their balance sheet, has also made some really big investments in their business. So I'll take that 3% reduction of shares and own more of the company year over year. That's pretty good in my books as well. I like to see that. And lastly here, just looking at the valuation, it's run up 40%. What are we thinking about in terms of the value? So current year, they're going to do about $5.30 a share. So if I multiply that out there, they're trading about 24, 25 times current year earnings. Next year, they're going to do over $6 a share. So when I multiply that one out, they're really trading around 20, 21 times next year's earnings. For a company that has an exploding cloud division, one of the best advertising businesses in the world, and has over $150 billion of cash on their balance sheet to buy back shares, invest in new businesses, invest in R&D, I'll take that 20 times multiple. I acknowledge there are some things going on with the company from a regulatory standpoint that can pose risks. But overall, I think this is a really sound company. They're going to figure it out. They own Android. They own YouTube. They own Google. They own cloud now, Google Cloud, which is an increasingly large part of the company. Went from about 8% of revenue to over 10% of revenue over the last few quarters, and that's going to continue to accelerate. So I think at 20 times earnings, this is still a really interesting buying opportunity, and that's why it's on my list. The third stock that I'm buying in the month of November 2023 is Jamieson Wellness. Jamieson Wellness is a consumer products company in Canada. You can see here, they actually just reported their earnings and they crushed it. The day they reported their earnings, the stock was up about 12%. You can see it went back a bit today, about 1%, but overall, the company's done great over the last couple weeks here, from 22 to $26 a share, almost up 20%. But I still think this company's in a really good spot from a value risk reward standpoint. So they pay a nice 3% dividend for starters. When we look at the company long term, it's really been in the dumps, especially since the pandemic in 2020 was up over $40 a share. Now we're down back to the low 20s here. And on the 52-week range, you can also see that we're only about 10-15% off of the lows. Looking at this company in terms of the results from Q3, they had an increase in 15% on sales. Canada actually didn't have a great quarter, but that was expected. Looking at some of their other businesses, it's a lot going on here. They acquired U-Theory last year, so some of this is just revenue recognition over a period that they probably didn't own it for the whole quarter. China was a byproduct of growth, but also that they bought out their distributor in China to own the end-to-end operation. So that really helped them there. And then international revenue is just organic increase in shipments to their distributor partners in Europe and other areas that they distribute. But you can see here their overall kind of sound bites. Canada actually declined 4%, which was expected just because last year they got lots of cold and flu shipments earlier in the year because of just the effect of the pandemic not being in their base anymore and people getting sicker earlier. They also made sure to call out that the U.S. business was not just being driven by the acquisition timing, that the asset that they bought, which is U Theory is the name of the brand, mostly out west, actually drove a lot of organic growth through distribution gains, e-commerce gains, innovation, and whatnot. So the business is doing fundamentally really strong. Looking at the overall third quarter here, you can see they delivered 9% growth on a consolidated basis. Looking at some of the areas that they delivered the most growth, we just went over it. US 88%, China 50%, international 11%. Total Jamieson brand is 15%. And from an adjusted earnings per share standpoint, it's still lots of things going on that they're incorporating this new acquisition. So to see them up a few percent, especially with their stock price down as much as it is, I didn't mind that either. Margins held a bit flat, which is good to see as well. So looking at the company overall, the company is currently trading at $1.1 billion. They're expected to do almost $700 million of growth, or $700 million of revenue in 2023. And then they actually have a pretty nice revenue mix too. They have about half the business coming from Canada, which is just a cash cow, number one vitamin, mineral, and supplement company in the country, I believe. So this is just a very developed cash cow that they have. They're using that money to expand through acquisitions like this one they bought in the US, which is going to do $150 million, and buying out their China distribution, which is going to deliver $50 million. You can see the really strong growth from them taking that part of the business. And then international, I think out of their four areas of doing business is probably their lowest focus. They don't talk about it too much. And you can see from a growth rate standpoint, you got higher growth rates on US and China, which is really what they're trying to accelerate, in addition to making sure the Canadian business remains strong, and international just kind of is what it is there. Going into, thought I was showing you the slide here. Going into just overall, one of the things I love about the company, and it's not really reflected when you look at their stock price year over year, which has actually been trending down, but their revenue and their earnings per share has trickled up year over year. You can see they did $300 million in 18, 350 in 19, 420, 450 in 21, 550 in 22, and with the acquisition of U Theory this year, they're going to do almost 700 million. So really strong track record of achieving revenue growth through one way or another. And that isn't just buying revenue without delivering bottom line earnings per share growth. They're driving a lot of synergies too over the years, from 85 cents to 95 cents to $1.15 to $1.30 to $1.55. This year they're going to be $1.60. I think they did have some margin hits, some extra costs from incorporating U Theory, but looking at this company long term, they continue to deliver growth both on the top line and the bottom line for investors. They're starting to achieve higher and higher margins, especially the last few years, from 21 to 22 to 22 and a half, which is great as they achieve scale. So I think this is a great company in a great segment of the economy, being health and wellness, that has a great track record of growth and has actually increased their dividend every single year since going on the public market. So you're getting a nice starting yield of 3%, and they've been a double-digit dividend grower too. So I think this one has a great backdrop, a great history ahead of it, and I'm still getting the opportunity of getting it on a bit of a discount at about $1.60 a share. They're currently trading at about a 17-ish times earnings here. So still much cheaper than lots of the CPG and consumer products companies in the US are trading, for companies that don't have as strong of a track record as Jamieson has pulled off in the last little bit. And just a reminder, if you're still watching the video, to give this video a thumbs up. It really does help with the YouTube algorithm. Also consider hitting the subscribe button and the bell if you haven't already. But the fourth stock that I'm going to be going into this month in terms of adding to my portfolio is just the TSX index here. I love just buying this ETF as a diversifier for my overall Canadian holdings. You can see here in the last year, it's about flat with the Canadian market. But when we look into the fund here, you can see, first of all, one of the things that I always look at is management fees, and their management fees are so low, just 5 basis points. So I like that side of their business. And then I get exposure to all the Canadian companies that I don't own individually. Personally, I don't own many energy companies because I don't really understand the space very much. I also don't own any Canadian tech companies, so I'm getting all that exposure through Shopify, Enbridge, etc. as we look through just kind of what some of the top holdings are. And then through just their representation of the entire Canadian economy, I just sleep good at night knowing that I'm not investing solely in individual stocks. I'm also getting a bit of hedge towards the broader markets, getting that dividend payment from every single Canadian dividend paying company that is held in this ETF. Just helps me diversify my portfolio a bit. So like having this one, especially at the management fee that it's at, and especially, as I was saying with Pizza, as we go through kind of more uncertain times, I'm not sure exactly what way the economy is going to go, exactly what sectors are going to face it well or benefit from it. Kind of like just having this overall hedge on the Canadian market, getting about a 3.5% starting dividend yield here based off the past 12 months of distribution from the Canadian market. So this is a bit of a safety play for me. But as I'm looking at stocks like Jamieson, like Google, that are maybe a bit more risky and dependent on the economy, I like having these overall hedges as well. So those are the 4 stocks that I will be buying throughout the month of November 2023. I've already started buying some of them because I'm a bit late making this video this month, but I hope you guys enjoyed this. Let me know what stocks you're buying this month in the comments, and I'll see you guys in the next one. Thanks.